Hello everyone, welcome back to our channel and welcome back to this video. In this video, we wanted to share with you how we are seeing the end of an era as Japan loses its top creditor status after 34 years. It's a turning point for global capital flows and fiscal stability. In a symbolic yet deeply revealing shift, Japan has officially lost its position as the world's largest creditor nation, a title that it held for 34 consecutive years. As of the end of 2024, Germany overtook Japan with net external assets totaling 570 trillion yen compared to Japan's 533 trillion yen. China remains in third place. This development comes not because Japan's assets have declined. In fact, they have hit an all-time high, but because the rest of the world, particularly Germany, is accelerating in new directions, both economically and geopolitically. But the timing is very crucial. This change coincides with the rising long-term borrowing costs globally and an intensifying scrutiny of how sustainable the post-2008 era of government debt accumulation really is. Let's talk about Japan's transformation: more assets and less liquidity. Japan's overseas assets rose on the back of an aggressive foreign direct investment strategy. Japanese firms poured capital into finance, insurance, and retail assets abroad, particularly in the US and in the UK. Unlike the portfolio investments, FDI is not easily unwound. Japanese investors just can't sell off these positions in times of stress. This structural shift points to a longer-term realignment in how Japanese capital flows. Less about choosing yield, more about operational expansion and diversification. Currency effects have also played a role. The weaker yen inflated the yen-dominated value of German assets, especially as the euro gained around 5% last year. But beyond the FX math, the broader trend is clear. Japan is no longer the world's dominant capital exporter. Meanwhile, the bond markets are flashing red. What makes Japan's status shift even more significant is its backdrop, an accelerating global bond sell-off. In US, the 30-year Treasury yields touched 5.15%, flirting with levels last seen in 2007. In Japan, the 40-year yield soared to record highs driven by a pullback by the Bank of Japan's bond purchases and a weaker demand by the traditional institutional buyers like life insurers. Germany, UK, and Australia are also seeing rising yields, a coordinated repricing of the long-term risk. Governments are now facing a stark new reality. A world of near-zero borrowing costs is over. Investors are demanding higher premiums to absorb the fiscal overhang created by years of stimulus, tax cuts, and underfunded social systems. As one strategist rightly said, bonds are beginning to signal that something is not okay in paradise. Let's talk about the structural fragility in the debt system. This is not just a Japanese issue. Across the G7, fiscal policies remain expansionary even as debt servicing costs spiral. The US public debt is now nearly 30 trillion or 100% of the GDP, up from just 35% in 2007. Japan expects debt servicing costs to rise to 230 billion annually in the next 4 years. In the UK, recent long-dated bond auctions revealed tepid institutional demand, forcing to pivot to a shorter-term issuance. Even Germany, long a bastion of fiscal discipline, is planning massive infrastructure spending and defense spending that could test its bond market's absorption capacity. The issue isn't just about how much the governments are borrowing, it's whether the historical buyers of sovereign debt, that is central banks, insurers, pension funds, will keep showing up. This brings us to a world of repricing long-term risk. Japan's fall from the top creditor is a wake-up call. It's not just about prestige, it's about capital allocation in a high-debt, high-cost environment. We are witnessing a transition from the liquidity-driven economies to credit-sensitive economies, from central bank dependency to market-driven interest rate discovery, from low-cost capital abundance to selective risk-priced capital flows. Investors, governments, and corporates will need to navigate a world wherein the cost of money is no longer artificially suppressed, and where sovereign credibility is once again up for debate. In closing, we can say that Japan's lesson is global. Record assets are not enough if liabilities and debt fragility grow faster. The bond market is becoming the ultimate arbiter of the policy discipline. Now that's what we wanted to share with you in this particular video. Hope you've enjoyed this video. Do stay tuned in for more. Thank you.